Welcome to the Deep Dive, your essential talk ticker summary. We cut through the noise of earnings calls to give you the insights that, well, really matter.
That's the goal.
Today, we're plunging into Sanofi's Q2 2025 conference call. Quite a quarter. Significant strategic moves, some promising product stuff happening.
Definitely.
But here's the puzzle, right? Solid operational figures, generally speaking, but the market reaction, pretty cautious, even negative.
That's exactly the tension, isn't it? Strong performance in key areas, sure, but investors clearly have some deeper concerns. It's not just the headline numbers, it's what they signal about the road ahead.
Okay, so let's lay out those numbers first. Get the baseline. Q2 2025 revenue for Sanofi, $9,994 million.
Just shy of 10 billion euros.
Right, and that's up 6.0% year over year. Looks even better at constant exchange rates, CER, where it's up a robust 10.1%.
But that top line did fall just a little short of the Zacks consensus estimate, so expectation versus reality there.
And then earnings. Their business EPS, that's the non-IFRS number, came in at 1.59. That was actually a bit ahead of the VARA consensus.
Okay, so a slight beat there. But then you look at the U.S. side, the ADR adjusted EPS per ADS, that's the American Depository share, was 0 to 90 cents.
And that one missed the Zacks consensus.
Exactly. So you see this divergence, different metrics, slightly different stories. It could definitely create mixed signals for the market.
And those mixed signals, maybe combined with other factors we'll get into, they led to a very clear reaction on the day.
Oh, yeah. Despite
what looked like, pretty solid operations, good momentum underneath, Sanofi's ADR price dropped significantly, 7.33% right after the call.
And the volume was heavy, too.
Heavy volume. Definitely a day of distribution, not accumulation. More big players selling than buying, basically. Not a vote of immediate confidence.
And what's fascinating, I think, is that even with that strong top-line growth, the market's focus just snapped immediately to the quality of the profit.
Right.
And the future implications of these big strategic decisions Sanofi's making, they're placing these huge necessary bets for the long term, but those investments, they come with short-term margin pressures.
And the market is pricing that in, not just the sales number.
Precisely. It's looking beyond Q2.
Okay, so if the market was scrutinizing profit quality, let's dive deeper. What actually drove those numbers, both the good and the maybe the concerning parts?
Well, let's start with the good, the growth engines.
Yeah.
Unsurprisingly, Dupixent. Still an absolute powerhouse.
Still going strong.
Sales surged to $3.83 billion. That's up 21.1% year over year. And it wasn't just, existing demand chugging along. It was boosted significantly by new launches, especially chronic obstructive pulmonary disease, COPD.
The COPD launch impact.
Big time. U.S. sales alone for Dupixent were up 22.7% to $2.88 billion. Management really hammered home its leadership in new scripts, total scripts, across all its established U.S. indications.
And they're sticking to that huge target rate, around $22 billion for Dupixent sales by 2030.
They reiterated it. It's ambitious, no doubt, but it really underscores how central Dupixent is to their whole long-term plan. I mean, that's a massive bet on a single drug, even one as successful as this.
It really is. $22 billion. Impressive target. But doesn't that, relying so heavily on one asset, even a monster like Dupixent, doesn't that create its own risks, especially thinking long-term patent expiry?
Oh, absolutely. It's a valid concern. Investors are constantly weighing that. Dupixent is spread across many indications, which helps diversify within the brand. But yeah, the U.S. patent expiry in March 2031, that's the cliff everyone sees.
Right.
Sanofi knows this, of course. That's precisely why they're pouring money into new launches, into the pipeline. They need to build that diversified portfolio to sustain growth after Dupixent loses exclusivity. It's a race, but Dupixent has to carry the load for now.
Makes sense. Okay, so Dupixent's the star, but it wasn't the only story. Vaccines look pretty solid, too.
Yeah, vaccines delivered good growth, up 10.3% to $1,214 million.
What was behind that?
Mostly two things. The global expansion of Beyfortus, that's their RSV prophylactic.
Okay.
And just seasonal timing effects from the late 2024-2025 flu season in the Northern Hemisphere. So important contributors showing some diversification.
And then they talked about this second growth leg, the newer launches.
Right. 9 recently launched medicines and vaccines, names like Altuvio, Beyfortus again, Kidara.
Great.
Collectively, these newer products generated close to $1 billion in sales just in Q2.
Wow, $1 billion already from the new cohort.
Yeah, that's 10% of total sales.
Yeah.
And get this, They contributed nearly a quarter of the Q2 growth.
That's impressive. Shows they're actually executing on bringing these innovations to market.
It absolutely does.
Yeah.
It shows the R&D investment is starting to, bear fruit beyond just Dupixent. Building these multiple engines is just crucial for their long-term story and, well, mitigating that single asset risk we were just talking about.
Okay, so the sales side has strong points, definitely. But let's switch gears to the financial plumbing, because the margins, that's a key part of this cautious market view, right?
Exactly. Let's look under the hood.
Gross margin improved 150 basis points year over year up to 77.5%. That looks healthy. Mostly product mix, operational efficiencies.
Standard stuff, but good execution there.
But then R&D expenses jumped 17.7%. Now, okay, part of that's a comparison thing. A prior year reimbursement made the base lower.
Right. The underlying increase was more like 7%.
Still, a 7% underlying increase is significant. Reflects that big investment push in innovation, plus absorbing costs from acquisitions. R&D is now, 19.1% of sales?
Almost a fifth of revenue going straight back into R&D. That's aggressive. It's crucial for the long term, for that R&D-driven biopharma pivot they keep talking about.
But it hits the bottom line now.
Absolutely. It put pressure on the business operating income, the BOI margin.
Yeah.
That saw a decrease, 210 basis points down to 24.6%.
And that was mainly the higher R&D.
Primarily R&D, yes. And also those increasing profit-sharing payments to Regeneron for Dupixent. You really see the commitment to the pivot in that 19.1% R&D spend. It's almost like a VC mindset inside Big Pharma.
Despite those pressures, though, free cash flow looked okay.
Yeah, free cash flow held up. Remained healthy at $1,429 million. So they're still generating cash.
So it sounds like that classic trade-off. Invest heavily now for future growth, but accept the hit on current profitability.
That's the narrative.
And beyond these internal dynamics, Sanofi's also been really busy reshaping the whole company, right? Strategically shifting the portfolio.
Very active. They closed that big Blueprint Medicines deal, around $9.5 billion, closed mid-July.
What does Blueprint bring?
It significantly strengthens their position in rare immunology diseases. Key asset is Ivakit. Fits right into that sharpened biopharma focus.
And on the flip side, getting rid of things, the consumer health business, Opella.
Right. That's now reclassified as discontinued operations. They sold a controlling stake back in April, brought in about $11 billion.
So selling consumer health sharpens the focus on the core pharma business.
Exactly. It streamlines operations, concentrates resources on innovative biopharma, and it provides a lot of capital, which, they're putting to work.
Like the share buyback.
Like the $5 billion share buyback program for 2025, they said over 80% of that is already done. So balancing investment in the pipeline with returning cash to shareholders.
And future deals, what are they looking for?
Management said they're primarily interested in early-stage assets for future business development, foundational stuff. But they're staying flexible if something really compelling comes along later stage.
Okay, so lots of moving parts. Given all these shifts, the financials, what does it mean for investors looking ahead? Let's talk outlook.
Right. Sanofi actually raised its 2025 sales outlook. They're now guiding to high single-digit percentage growth at CER.
That puts them at the top end of their old range.
It does. And importantly, they stressed this uplift is from the underlying business performance. It explicitly does not include the Blueprint acquisition impact yet.
Okay, so core business is strong. What about earnings guidance?
They confirmed the EPS guidance. Expectation of low double-digit business EPS growth at CER. That's 4 buybacks.
Which sounds like maybe just holding the line, but...
But it's actually an implied upgrade, because that guidance now includes absorbing several hundreds of millions in additional costs from those newly acquired businesses, like Blueprint.
Okay, so the underlying business is performing well enough to offset those new costs and still hit the original target.
Pretty much. But as we discussed, the market's cautious tone reflects an awareness of, some headwinds coming down the pike that could challenge those numbers.
Right, it's not all smooth sailing. Foreign exchange, for example, expected to hit sales by about 4% and EPS by maybe 6%.
Yeah, FX is a drag, and potential U.S. tariffs are on the radar too. They said they're monitoring it, deemed manageable for 2025 because they have inventory stateside.
So not baked into guidance yet.
Not yet. Then there's flu vaccines. Sanofi expects a mid-single-digit percentage decrease in total flu sales for 2025.
Why the decrease there?
Competitive pricing pressures, especially in the U.S. and Germany. They mentioned a specific one-off hit in Germany where a competitor reset prices aggressively.
Okay, but the big one, the point that seemed to really weigh on investors, That was the Regeneron situation, right?
Absolutely. The Regeneron development balance reimbursement. This sounds technical, but the impact is clear.
What is the impact?
It's projected to cause a negative year-on-year BOI impact, hitting that operating income of about $300 million in 2026.
Okay, hit next year.
And then a much bigger negative impact, around $800 million in 2027.
Wow, 800 million hit in 2027. That Regeneron cost step up sounds significant. Can you maybe clarify what this reimbursement is and why it ending hurts their operating income so much?
Sure, let's break it down. Think of it like this. Sanofi and Regeneron co-developed Dupixent, right? Under their original deal, Regeneron was essentially paying Sanofi back for a chunk of the development costs.
Okay, like getting money back.
Exactly. Now, as that specific reimbursement agreement winds down, Sanofi starts shouldering more of Dupixent's ongoing R&D costs and also the profit-sharing payments directly.
So the incoming money stops and Sanofi pays more out.
Kind of. It's not just an expense disappearing. It's more like Sanofi is effectively buying back a bigger piece of Dupixent's future profits. It's strategic. They want more ownership of their star asset.
Ah, okay. So it's a deliberate move to own more of Dupixent long term.
Right. But yes, the financial effect in 26 and especially 27 is a significant margin drag. It's temporary, though. From 2027 onwards, the way costs are shared normalizes, so that negative year-on-year hit actually goes away.
Got it. That makes more sense. A strategic cost with a clear, but challenging short-term financial impact. Management also mentioned maybe exploring direct-to-patient selling models, tactical lever against PBMs and pricing pressure in the U.S.
Yeah, that was interesting. It really highlights just how intense the pricing pressure is in the U.S. market.
Yeah.
Direct-to-patient cuts out the middleman, right? Pharmacy benefit manager.
PBMs, yeah.
It could potentially give Sanofi more control over pricing, patient access. It's a bold idea. Could really shake things up in certain areas if they pursue it seriously.
So with all these financial shifts, strategic changes, the future really hangs on the pipeline delivering, doesn't it?
Ultimately, yes. The pipeline is absolutely key to making this whole long-term vision work.
What are the big catalysts coming up that we need to watch?
Second half of 2025 is important. Key phase 3 readouts, notably the first results for amlitelimab in atopic dermatitis, AD.
Amlitelimab. What's the potential differentiator there?
Sanofi is hoping for similar efficacy to the standard of care, but, and this is the kicker, with much more convenient, longer dosing intervals, potentially as few as 4 injections a year.
Wow. 4 shots a year versus, every 2 weeks for Dupixent?
Something like that. It could be a massive game changer for patients. Think about adherence, quality of life.
Huge difference. That would definitely grab attention. What else?
Also expecting phase 3 results for talerbrutinib. This one's in primary progressive multiple sclerosis, PPMS. Management seemed quite positive, highlighting biological overlaps with other conditions, suggesting maybe positive results here could read through, have broader implications. And this all ties back to that strategic narrative, becoming an R&D-driven, AI-powered biopharma. There's streamlining the portfolio, yes, but pouring investment into this pipeline. It's not just about one drug, it's a whole philosophy shift.
And it's worth quickly mentioning, too, their focus on sustainability, right? Ranked highly by Time magazine.
Yeah, 10th most sustainable company globally across all industries, #1 in pharma and biotech, according to Time. They highlighted eco-design principles for new medicines. It's part of the modern pharma narrative, not just what you make, but how you make it.
Right. So looking out further, they see a good growth runway.
They expect an attractive growth profile until at least 2031, which, not coincidentally, is when that Dupixent compound patent expires in the U.S. Gives them a clear window to execute on this pipeline and strategy.
All right, let's talk trades. And remember, everyone, this is our not financial advice segment, purely educational musings here.
Always the disclaimer.
Always. Okay, given this market fixation on near-term profits versus Sanofi's very long-term R&D game and those binary pipeline events, I'm thinking maybe a long straddle on Sanofi, let's say for the December 2026 expiry.
Okay, a long straddle. So you're not picking a direction up or down. You're betting on a big move, one way or the other.
Precisely. That's what a straddle does. Buys a call and a put at the same strike price and expiry. You profit if the stock makes a significant move. Doesn't matter which way, it just needs to move enough to cover the cost of the options.
And the rationale for Sanofi specifically.
Well, with these huge pipeline readouts coming, amlitelimab, talerbrutinib, plus that Regeneron cost step-up looming in 26 and 27, and this whole strategic pivot, It feels like the market might be underpricing the potential for extreme volatility.
You think the current implied volatility is too low for the risks and potential rewards?
I think it might be. On the upside, what if amlitelimab is a game changer? 4 shots a year for AD. Or talerbrutinib really hits in PPMF. That could cause a massive re-rating of the stock. The transformation story finally catches fire.
The hockey stick upside.
Exactly. But conversely, drug development is super risky. What if there's a big pipeline miss? Or unexpected competition pops up? Combine that with the Regeneron BOI hit really starting to bite in 27. You could see a sharp downside move, too.
So the straddle positions you for either outcome, the home run, or the strikeout without needing to guess which one it'll be.
Right. It offers exposure to that potential hockey stick upside or the sharp drop from a major setback. Given the binary nature of these readouts and the shifting financials, a big move seems plausible.
It's certainly an aggressive play on that potential for dramatic shifts in perception around these key catalysts and financial transitions. Interesting idea.
So let's wrap this up. Sanofi's Q2, solid top-line growth, definitely driven by Dupixent still, but also that strong cohort of new launches starting to contribute meaningfully.
And they raised the sales outlook, confirmed the EPS guidance, even while absorbing those new acquisition costs. Shows underlying strength.
But the market reaction was cautious. Increased R&D spend, that evolving Regeneron profit-sharing structure hitting margins. It's contributing to that caution despite the operational wins.
It really is that classic story. Long-term vision hitting short-term financial reality checks.
So looking ahead, what are investors watching? Those pipeline readouts are huge: amlitelimab, talerbrutinib, Dupixent's continued growth trajectory, of course, and how Sanofi navigates all these pressures, FX, potential tariffs, U.S. pricing battles.
Yeah, the challenge is clear. Can they translate all this R&D progress, this strategic reshaping, into sustained, profitable growth that actually convinces the market?
Can they turn that caution into conviction?
That's the multi-billion-euro question, isn't it? Can this pivot to an R&D-driven, AI-powered biopharma generate enough breakthrough value to overcome the near-term margin hits and truly re-rate the stock? We'll be watching very closely.
Absolutely. And remember, this information is for educational purposes only. It is not financial advice. Please always do your own due diligence before making any investment decisions. Thanks for tuning in to the deep dive. We'd love to hear your thoughts on Sanofi's quarter. Feel free to share them.